Fantastic. All right, welcome everyone to our weekly accounting research webinars. Thank you very much for joining. Today we'll have Christian Leuz presenting his research on CSR and sustainability standards. Before we give word to Christian, let me make a couple of announcements. So we have more speakers lined up for our seminars. We'll try to keep our seminars every week. So we have Brian White, and then Jennifer Bluin, and then we also have Greg Miller and Regina Wittenberg scheduled. Please check our website. We will update our website with more speakers as we have them scheduled. Second, we also slightly changed the registration process. Now it should be simpler. If you go to our website and you register for Brian White's seminar, you will see that we'll have a different registration form, and this will automatically send you the updates and also reminders about the seminars. Finally, today's paper that Christian will present is a somewhat longer paper, which includes literature review. So we will give Christian around 35 minutes to present and use the rest of the time for the Q&A session. If you have a question that you would like to ask Christian, please post the question on the comment chat, and then I'll call you, or me or Emmanuel will call you on the question. And please keep your microphone muted unless you ask a question. All right, with that being said, let us turn to Christian and his presentation.
Okay. Okay, so you should be seeing my screen now. Are we good?
Yep.
Okay, perfect. Well, thank you, Roman, and thanks to the Miami crew for organizing this webinar. This is very cool, especially cool that you can reach a really large audience. So thanks a lot for having me. I'm delighted to see that many have logged in. Seeing lots of friends and colleagues is fantastic. I hope you're all doing well, and I look forward to your comments. This is joint work with Hans Christensen and Lucy Heil. And as Roman was saying, it's a somewhat different paper in that it came out of a report, an independent research report we did for the SASB, and then it morphed into a sort of higher level survey paper. So let me start with sort of a big picture introduction and then get into the paper. So as we all are aware, sustainability and CSR issues, climate change, environmental issues are massive challenges, and they're on lots of people's minds. I should probably also say that throughout the talk, I won't make a distinction between CSR and sustainability and use them interchangeably. So, we're all aware of these challenges. I put up here the Fridays for Future as an example of how big of an issue it's become. The business leaders and businesses are also taking note. One thing to point to here is the famous letter by Larry Fink, A Sense of Purpose, where he talked about how there's sort of the company doesn't just serve the shareholders. Or more recently in 2019, and that was pretty remarkable. The Business Roundtable changed its statement of purpose of a corporation. They were known for their 1997 statement, where they basically, made the point that the paramount duty was to serve the shareholders. And then with the 2019 statements, they changed it and basically said that there's a fundamental commitment to all our stakeholders. And interestingly, if you look at the list that they gave of stakeholders, the shareholders actually come last. The regulators and central bankers are also concerned about climate change and climate risks. They're talking about both transition risks and physical risks. And the G20 and the governors have asked the Financial Stability Board to review the financial stability implications of climate change. And here is where I want to point something out, which I think is quite interesting. All of this has led to a major push for sustainability reporting. And to us as accountants, I think this is really important to recognize that many see CSR and sustainability reporting as sort of a natural or critical step in achieving environmental and climate goals. So we're to some extent, at the core of the policies that people are thinking about. And to illustrate that with an example, the FSB, when tasked, created this task force, and where the task force immediately went, one of the places they went was climate-related financial disclosures, by basically saying we need more disclosure for decision-making and to understand the risks. Another reason why there's this major push, there's also lots of standard setters out there proposing solutions. There's the GRI, there's the SASB, there's something that came out of the task force. So there's quite a lot out there. And then there's also a lot of ratings, and the ratings rely heavily on the company disclosures and reports, again, saying that company reporting is going to be a central piece of this, of tackling these environmental and climate issues. Another reason, sort of where's this push coming from, or why do we see this push? I think it's people understand that it is difficult to address the challenges of climate change through a traditional regulation. It's ultimately a fundamental, sort of a global problem. There's complicated politics between developed and developing countries. And so because it affects essentially all countries, it isn't sort of a simple problem that you could just pass sort of some environmental regulation and then you're done. You don't necessarily get everybody to sign on. On top of that, traditional regulation is well known to have unintended consequences. And so the CSR standards often come across as being less intrusive, merely describing disclosure. And then transparency is often viewed as a good thing. It's sort of politically hard to argue against transparency, which is sort of one reason why I think people are pushing that margin. And it's this idea that disclosures unleash the incentives and the market force. It goes back to this old adage that sunlight is the best disinfectant. And there's sort of many examples where disclosure is used in this way. I put up here corporate governance, consumer protection, healthcare, and so on. I want to point out one other thing, which I think is interesting, is reporting is also viewed as part of the problem. So I was telling you earlier about the 2019 Business Roundtable, turnaround in their sort of statement of purpose. That actually came out of criticism of the short-termism that potentially gets created with quarterly reporting. So Warren Buffett and Jamie Dimon, they teamed up kind of to end quarterly reporting, wrote an op-ed, we're talking to various business leaders. That is what triggered the Business Roundtable. So again, reporting is actually very central to this entire debate, is what I'm basically trying to say. And then, lastly, there's lots of regimes already out there. They range from narrow to broad. I put together here a little chart. This is, by the way, if you're not familiar with it, the reporting exchange is collecting data on these various regimes. So by our count, and we're including here comply or explain regimes, there's close to 170 reporting mandates out there across countries worldwide. They capture different aspects. Some of them are environment, some are social issues, some are broad, some are focused on governance and so on. But there's a lot essentially out there. Now, just to give you a quick flavor, and I'm sure many of you have seen this, the sustainability reporting has many faces. It's very diverse across companies. So I just put up a couple examples here. Alcoa on carbon, Walmart on conflict minerals, Apple talking about recycling, then Coca-Cola again talking about carbon, and Bank of America talking about employee diversity. So if you sort of had to summarize what does sustainability reporting look like, it's very apparent that you have a very diverse set of users and uses. It's very wide ranging, and it's also rapidly changing. The nature of the topics, what you see, what companies are talking about, it's often qualitative, sometimes boilerplate. You do see some quantitative information, and sometimes it can get very specific. And one feature that I want to come back to, because it plays into something that we'll point out in the report, is that they're often, given the nature, are non-monetary in nature, which I think is important to recognize. So to sort of, when you look at this landscape, you would say that there's substantial heterogeneity in corporate disclosure practices, which reflects the heterogeneity, obviously, in business activities. Not every CSR activity is relevant for every company, but it also reflects heterogeneity. And I think this is something that comes very natural to us accounting researchers, but it's important to recognize that there's heterogeneity in the cost and benefits of providing this information, which then drives the heterogeneity in the practices that we observe. There's a general upward trend in CSR disclosures, and that's going to continue even without a mandate. And when you talk to people or when you follow the debates, it's very clear that there's sort of no clear sense for best practices, which is why many practitioners and companies are basically pushing for a set of standards, and many have sort of expressed the view that there's a need for harmonization and a mandate. So that's kind of where we come in, and I'm citing here Michael Jancy. He's the CEO of Sustainalytics, the largest sustainability ratings company, where he's basically saying we're past voluntary disclosures, it's time for a mandate, and he makes this comparison to which I'll also come back that he calls for an IFRS for ESG, so that that heterogeneity gets harmonized. So this is where our report kind of comes in, right? So again, we wrote this initially as an independent research report to the SASB, and then turned it into sort of a bigger overview paper. And the starting point for this paper is essentially that we assume a hypothetical mandate and then ask us what we can say, and some of it will be speculation, but it's heavily informed by the literature that's out there. So we rely on a lot of work from people that are probably listening in, and then we interpret it and extrapolate it. So this isn't original research that we have done, although Hans, for instance, has done some work in that space, and I'm currently sort of engaged in some work in this area as well. So to give you a brief overview, this thing is very long and we can't get into all the details. But basically, you could say there's sort of, after we've defined the scope and a bunch of terms, there's basically sort of two parts to it. Is one, what are the things that we can say with some confidence based on the research we have, accounting, finance, and economics more broadly, but also specifically the CSR literature. And we put together, actually, if you go to SSRN, we also put together kind of an appendix where we kind of categorize the literature and put them in tables, and we hope that that's useful to people. There's a lot out there. And then we kind of try to say, what are some key issues that we need to consider when we're thinking about a mandate? We also provide a little bit of an overview of what are some of the determinants. It's sort of more to understand some of the forces that are driving companies to provide information, even in the absence of a mandate. But then the core of the paper is basically first focusing on studies that look at the stakeholder effects. So we start with the usual capital markets, but then also look at other stakeholders like customers, employees, and so on. And then we basically say, well, because the stakeholders respond, firms are likely to respond to this as well because they care about the stakeholder responses. And so what are some of the potential real effects, and what do we know about those from the literature? And then we get into a couple implementation issues, one of which I want to highlight is related to materiality. But we'll also talk about standard setting, and you won't be surprised to hear, given sort of our other research, that we also put a lot of emphasis on thinking about enforcement. So here's kind of a quick summary of some of the key points in the report, some of which I will elaborate on in more detail. So there's many insights that we already have from the prior literature to the CSR, that apply to the CSR mandate. So we can actually draw pretty heavily on what we know from financial disclosures in accounting and finance that is relevant here, and I'll come back to that. Secondly, the magnitude of the information effects depends heavily on the compliance of firms with existing rules. And that was something that wasn't obvious to me, at least, when I was going into this, and I'll explain this a little bit. So there's sort of something fundamental that we need to sort out. Then the CSR reporting standards alone are unlikely to have sort of major effects, or they're probably going to be pretty limited. And there's going to be some parallels here to the IFRS debate. Then when we look at the CSR literature, our sense is there's a real need to differentiate between the effects of the underlying CSR activities and the effects of the reporting. And obviously the second part is what accountants care about or focus on in particular. We have a lot more evidence on voluntary CSR reporting, and the evidence is actually quite different from the evidence that's emerging on CSR reporting mandates. And that already points to that selection issues is something very important to think about. CSR mandates have very complex real effects, and this comes in part because it speaks to a broader audience, right? It's deliberately speaking to sort of non-investor audiences and stakeholders, and that makes predicting these effects quite difficult. And then lastly, the materiality of CSR disclosures is really a non-trivial issue that I think we as accountants could contribute a lot. So we view our report really as a calls to arms for the accountants. There's a lot of things that I think we can contribute and interesting issues that we should study. So the ones that I had in blue are the ones that I'm going to talk a little bit more about. So let me start by saying that there are quite a few things that we can say with reasonable confidence, and because this is sort of accounting researchers' audience, this will you will be very familiar, and we can go over this pretty quickly. If CSR disclosures provide information that's relevant to capital markets, I think we can say with confidence from the literature that we have, and here a lot of the financial disclosure literature will help us, that they will have capital market effects. So more and better CSR information should increase liquidity. Maybe with the cost of capital, we have a little bit less to go by or to rely on, but there could be cost of capital effects, and it could also improve the capital allocation, just as other financial information, when it's new and relevant to the capital markets, will do. We can also say with confidence that other stakeholders will respond to this information, not just the shareholders. So the response won't be limited to investors. And as we have seen in this, literature on investor sophistication, I think a lot will depend also on the level of sophistication and knowledge of the receivers. And as has emerged, processing costs will matter here as well. So those are things that I think we can transfer over quite literally. Companies are going to care about the investor and other stakeholder responses. And so we're going to get a feedback loop. So this is this idea where the real effects come in, is because the stakeholders respond, companies care about these responses of their stakeholders, they will adjust their actions, and that will lead to this complex set of real effects that I have mentioned. And then lastly, CSR disclosures can have proprietary costs. And this is, again, something that I think is pretty important to recognize. And because CSR disclosures are about business issues or the processes, they're often about things that are actually potentially quite sensitive for companies. And this is going to be true, especially if we're pushing for standards for various reasons that are fairly specific and detailed. So if we're worried about boilerplate disclosures, people often say, well, we need to be more specific and we need to make them more detailed. But then that often leads to potentially proprietary costs. And here's a shameless plug of some of my own work with Matthias and Steven, where we basically show that in the aggregate, there could be negative effects on innovation when we force firms to disclose this information. There are basically a couple of issues that will likely matter a great deal: measurement, avoidance strategies, enforcement, and reporting incentives. And you're probably not going to be surprised. They sort of very much tie in with work that Hans, Lucy, and I have done in international reporting. I think there's a lot of parallels to that literature that are quite interesting. So let me illustrate this sort of enforcement avoidance strategy angle with a paper from Thomas Rauter, which I think is very nice and illustrates this issue of avoidance. So he studies extraction payment disclosures for oil and gas companies, and he finds that companies change their payments, and if you think about the intention of that regulation, probably consistent with the idea of limiting the corruption. But then he also finds that there is this shift in business. There's a reallocation from the disclosing firms to the non-disclosing firms, which is what I put up here. So the red ones are the European firms that have to disclose, and then the non-disclosing competitors are in this case, the US firms, you see that they're sort of increasing their investments, whereas the investments for the European firms is going down. He has some additional evidence that's also consistent with this reallocation from the licenses that are being granted. So this is basically saying when we're dealing with a global problem, this is a lot more tricky, and we need to think long and hard about these avoidance problems. So the big picture that I'm driving towards is that there is quite a few results in the literature that suggest that there are lots of unintended consequences with transparency regulation as well. It's not clear that transparency regulation is innocuous or more innocuous than some of the command and control or the traditional regulation. So I already mentioned Thomas's paper, but we also have the multitask agency literature that would say there's a lot of focus on what's measured, not necessarily what we ultimately might care about. Here's a paper that I cite a lot in this context, which I think people should be aware of. It's in the JPE by Dranov et al. It's about physician report cards. So forcing physicians to report about the outcomes from cardiac surgery. And one of the pernicious effects that they find there is that physicians become more reluctant to operate on the sickest patients. And so that obviously is not a desirable outcome and an unintended consequence of that regime. But if you think about why is that happening, it is happening because the physician is basically worried about operating on a relatively a patient with relatively severe conditions because they're more likely to have negative outcomes. But the problem here is that we're not measuring how sick patients are on the way in before they have the surgery. If you did that, then I think you would have less of that effect. So that's why I put it under measurement. I already mentioned the forced disclosure could hurt innovation. And then there's a couple of other effects that I don't have the time to go in. We can talk about that later if you have questions about it. But basically reinforcing the theme that transparency regimes need a careful analysis of the costs and benefits, and that there will often be complex real effects for CSR reporting, and that they're non-trivial, especially because we're spreading the audiences so wide. The second insight, and this one again was one that I didn't necessarily foresee going into this. So whether or not there's going to be large information effects from a CSR mandate critically depends on whether companies withhold material CSR information already. And the part that I think is important to understand is that the way we currently write regulation, companies are not supposed to omit material facts. There are regulations like SK that say firms that describe any known trends and uncertainties that have a material impact on their revenues and incomes. They never say this does not apply to CSR information. They don't say this is only for financial information. It does not exempt. So to the extent that CSR information is material and relevant to investors, in principle, companies already have to provide certain information or can omit material facts. And so what that means is if companies already provide a lot of material information that is in the CSR space, then the mandate or the standards are not going to produce a lot of new information. So then if we're thinking about, well, what is the standards going to do? The benefits are going to come from standardization, from benchmarking, sort of peer effects, or cost savings by having one regime that everybody follows. If we think there's a lot of non-compliance, then I think the mandate is going to force out potentially a lot more information. And then we need to think about these information effects a lot more. And we're not taking a stance in the report whether or not there is a big enforcement or compliance problem, but what we're basically saying that underlying issue is a key issue that we need to sort out. The third one, and this is where there's a lot of parallels to the IFRS literature, is you might say, well, if, back to this slide, if there is this issue that there's underreporting, maybe by telling companies what in a given industry is material would make this avoidance or compliance issue smaller. But here is where I think standards alone are likely to have a fairly limited effect, similar to what we saw for IFRS. And the reasons are the standard reasons we've talked about in the IFRS literature. There's a lot of discretion in the rules. The reporting incentives of firms are heterogeneous. That is why the CSR reporting, the voluntary reporting we're seeing is so heterogeneous in the first place. And so we've seen with IFRS that the standards alone do relatively little, and that we need to think about the broader reporting infrastructure and that plays a crucial role. And so if we want more harmonized CSR reporting, that's an if, but if that's the goal, then it requires substantial investments into the private assurance, into the public enforcement mechanisms. And we need to think about that interplay with existing elements like the auditing. And one thing that we hear a lot in that space is that people say, well, then we have to make the standards more specific so that we're reducing the discretion and the boilerplate disclosures. But then keep in mind that the more specific you make them, the more you make them specific to certain industries, that's going to run counter to comparability and harmonization. So I think this is a non-trivial nut to crack. And then the last point that I want to talk about is this issue of materiality. Sort of determining what is material and to whom is likely a lot more difficult for sustainability information. The information, the CSR information, as I was saying earlier, is rarely expressed in monetary units. And so that already makes it sort of difficult because materiality is often was defined the thresholds in monetary terms. And then it's often about long-term activities or long effects, that are arise in the with a long horizon. And I think that again makes it difficult to sort of forecast or to foresee what is going to be material. There are industry components, and that's how the standard setters have approached this. They said for each industry, let's sit down and think about what likely is material. But at the end of the day, it's likely to be determined at the firm level. And then the other issue that I wanted to highlight here is that the materiality of these topics is very time variant. Right? So think about plastic bottles. 10, 15 years ago, people probably wouldn't have said that plastic bottles is a material issue, but it's become one. And to give you another one that kind of, I think, even better illustrates the issue is that the CSR issue itself can be financially immaterial, but can become financial material to the company as a whole. So think of drinking straws in the beverage industry, right? So think of the straws that, Starbucks or some beverage company uses when they hand out their product. They themselves are small, financially immaterial in terms of their cost. But if the non-investor stakeholders respond to it and they start boycotting because they object to the use of plastic straws, now that can very quickly become an issue that is material to investors. And all we're saying is that that's very difficult to foresee and know ex ante. And here's another example, and this is I took this picture when I was running earlier this year when I was in Frankfurt. And I don't know whether you've heard about it. Siemens got in a lot of trouble and under a lot of pressure from environmentalists and Greenpeace. So this is a Greenpeace protest here because they had agreed to deliver signal technology for trains at the Adani coal mine in Australia. And so a lot of the protests have first focused on the coal mines, and Siemens is delivering technology that for the trains, so signal technology for the trains that help delivering the coal from the mine. This is an $18 million contract that Siemens had. Siemens has 86 billion in revenue. So in terms, again, financial materiality, it doesn't hit the thresholds for financial materiality. And even in this case, the Sustainability Board did not even consider the case ex ante. Now, of course, they wish they had because of the massive protests, and it's become an issue for the CEO, right? Again, illustrating how these, what first looks financially small can actually become a major issue for a company. So to conclude, I want to hit on a few challenges and then open it up for questions. So how are we doing on time, Roman?
So you still have a couple of minutes. Yeah, perfect. 29 minutes. Oh.
Okay, so a couple of challenges, and then we can maybe go into these challenges a little deeper. First of all, you're not going to be surprised to hear identification, causal inferences from me, but it is really critical here because a lot of the research that we're going to be doing in that space is going to be policy relevant. And so if you want to inform policy, I think thinking about identification and causal inferences is going to be very important. I also want to point out one issue that often comes with studying these real effects is that when we study the responses by the receiver, they don't necessarily imply that we've achieved the policy goal. So think about the famous Gin and Leslie paper on restaurant hygiene, where they had to put up hygiene report cards in the restaurants. If the consumers sort and they go to, the cleaner restaurants, and therefore the revenues of the restaurants go up, that in itself doesn't mean that we made the restaurants cleaner, right? If we then see fewer foodborne illnesses, it could merely come from, well, the customers don't go to the restaurants anymore that don't have certain hygiene standards or have a lower report. So, oftentimes we struggle. We don't have the kind of data that would show that there actually was the real effect that achieved the policy goal. And that's a challenge for this research. There's a lot of bundling of disclosure rules with other changes. So I'm doing some work with Pietro and Giovanna on hydraulic fracking disclosures. And there we found that the disclosure of the fluids was bundled with wastewater treatment rules. Then because there's often other rules in place, there is going to be this path dependencies that we have to worry about. Prior conditions matter. And then one that I think is it's almost, central or comes with the fact that we're studying disclosure is that often the behavior in the pre-period cannot be observed, because if the information about what companies were doing in the pre-period was already readily available, then the disclosure rule wouldn't really have a material impact, right? So this is an issue that we face in many areas here. And so an interesting paper in this regard is Saurabh Tomar's paper on CO2 disclosures that I can talk a little bit more about later. But that's sort of an example where through clever approach, he was able to figure out what companies' CO2 disclosures were in the pre-period by mapping it into carbon monoxide disclosures. One other point here is dissemination could matter too. So that's sort of another angle that is important to study in the mine safety paper by Christensen et al. is an interesting one in this regard. And then finally, externalities and spillover effects are key to the mandate, and they're rampant here. But they're very difficult to estimate. So I think what I'm basically saying here, yes, there's lots of interesting stuff to study, but the challenges that we're going to face on the research side are non-trivial. And here's sort of two key terms that we all should be familiar with if we're working in that space: is the Sutvar assumption and the reflection problem. And again, I'm gonna, I can elaborate on that if you guys want to talk about it some more in the Q&A. And then because of the externalities, I just want to remind everybody that often will require taking the analysis to a higher level of aggregation so that you can aggregate the spillover effects. But there's going to be a trade-off. If you aggregate too much, you're not going to have a lot of N over which you can do your analysis. And so there's basically sort of this trade-off of like, which spillover effects are you still counting in, and which ones are you going to assume are so small that the Sutvar assumption still applies. So to conclude, I think I made these points, so we can do this very quickly. I think there's lots of complex issues to study. So as I said, this is more calls to arms for the accounting researchers. I think it's way too early to say whether the mandate would be a good idea. If you were to think about this net, and we're not saying that in the report, we're actually tempering expectations of what a CSR disclosure mandate, especially just the standards, would be able to achieve. And then lastly, very much in line in what we've been arguing in the IFRS literature is, let's not just discuss the standards, but focus on the broader infrastructure. Enforcement will be a very important element, and there's sort of other broader elements that we should bring into the debate. So let me stop here. Thank you very much.
Thank you very much, Christian, for excellent presentation. So now we'll turn to the Q&A session. And the first question is from DJ.
So Christian, one of the issues with CSR reporting, unlike financial reporting, where we actually have a concept statement and we have a target audience, there is no real audience for this, because people just use the word stakeholders. And I don't know what that means, and they'll say, oh, it's employees, it's your customers, it's society and local community. But even if you look at employees, is it future employees who you're trying to attract? Is it past employees who are depending on their pension benefits? Is it your competitors' employees who you're putting out of business? Like, what is a stakeholder?
Yeah. So I think we very much agree with what you just said, and I think the one of the challenges in predicting what a mandate would do in this space comes exactly from what you just said. Is the set of people that are potentially, or stakeholders that are being addressed with the reporting regime are so broad that it's almost impossible to foresee what the potential effects of such a regime could be. And they're, not well-defined set of stakeholders that we have with financial reporting. But importantly, I want to sort of make two more points here. One is that the standard setters sometimes will say, you know what, we understand that there's sort of certain audiences out there that maybe that isn't the purpose of why we're doing CSR reporting. So we're going to focus on what CSR reporting and CSR information that is relevant to investors. But if you take the point that I was just making about materiality a few minutes ago, the problem is you can't separate this anymore. If I'm putting information out as a company that then potentially becomes relevant to the non-stakeholders respond in a way that is financially relevant to the company, now it's relevant to the investors as well. So this separation between, we're only talking about CSR information that's relevant to financial investors, I don't think will work. And so that makes this problem that you just pointed out, I think, very pertinent. On the flip side, think about why we're doing this. I think one reason why people are pushing for reporting is because we do think we have massive environmental problems and we have externalities. And so in part, I think the idea is there are social costs and we're trying to address them. It's just here, I think the problem is a little bit, it's like once you let the genie out of the bottle, you're going to have sort of this wide set of effects that are very difficult to foresee. And we don't have an answer to that question. So on one hand, I agree, but on the other hand, I think it comes with the nature of the beast that we're trying to address these externalities that are outside the typical financial realm.
Thank you. I believe Jeff Hales wanted to comment on that as well.
Yeah, can you hear me?
Yep.
Yep.
Yeah, I was just going to suggest that it is in fact that there are potentially broad stakeholders that companies try to communicate to, and like Christian said, sometimes it's very focused, and so I think the fact that it's not that well understood by accounting academics doesn't mean that companies are not actually very clear in which relationships they're trying to manage, and which of those relationships are going to be important to communicate to investors. And I totally accept Christian's idea that there's a linkage between what investors care about and what other stakeholders care about. I would just suggest that it's not necessarily just because investors want companies to manage all of their important relationships doesn't mean that they need to hear in mainstream disclosures about how the company is managing all of those relationships. They can be focused on a smaller set of issues, would be, my perspective.
All right. Thank you, Jeff. So the next question we have is from Doug Anna.
Hello, Christian. I enjoyed reading your paper, although at 100 pages, it took a little time.
Thank you for reading it.
I was interested in your initial assumption that there exists a mandatory and enforceable structure of reporting regulations. The characteristics that you openly discuss in the paper suggest that CSR reporting might not lend itself to a mandatory, objective, enforceable set of reporting standards. There's going to be industry differences and firm differences. What if the solution eventually becomes something like a Rochester motivated demand disclosure system? Can you speak to the economic aspects of that if we're unable to accomplish your first assumption?
So let me first clarify one thing. So we, the reason we said let's assume that we're imposing a mandate was more because there was a lot of discussion at the time when we first started. There was quite a bit of discussion whether the SEC might actually endorse a standard setter for the material disclosures in the CSR space. And so there was a possibility that we might, and I still think there is a possibility we would get that kind of a mandate. Secondly, since then, I think the push for mandates has become stronger, right? That's why I put up the example of, Michael Jensi that was reported in the FT, and there's quite a lot of other people out there. So we were just saying, let's take this as a starting point, assume we had a mandate, we get one. Now, you're raising the possibility and saying, well, maybe we can have a mandate. I don't think that we can have a mandate. I think, we could say everybody adopts the SASB standards and have a similar arrangement that we have for the FASB or GRI or some other standard setter. I think it's feasible. Whether that's a good idea or not is not something that we're endorsing or saying, because I think what we've learned from the report that it's very difficult to figure out whether net that would be a good idea. So we would actually be totally fine with, I think, if in the end we concluded, once we've done a careful analysis, that maybe it's not clear that the benefits outweigh the costs, that we're going to go with more of a voluntary demand-driven regime. And we see that companies are providing a lot of information, and they can use the standards that are being put out, and many do, for their voluntary disclosures as guidance so that they become more comparable. And I think that would be a fine outcome too. The reason we didn't put that in the report as well, we do have a few comments on it, is just simply it would have made the analysis even more complicated, because then every time you had to think about the consequences, you would have had to think about, well, how many of the firms would adopt voluntarily, if the consequences are this. And so every time you'd have to think a little bit through what the adoption strategies and mechanisms are going to be, what fraction is going to adopt. And it just made it too complicated, which is why I said for simplification, let's just assume we're imposing a mandate of a broad set of standards. And what do we think the outcomes potentially could be?
All right. So our next question is from Gabriel.
Hello, how are you? So
Hi,
congratulations for the presentation. I, as a living in a peculiar country and CSR reporting issues, I would like to know your opinion. In your opinion, what would be the main Brazil's CSR reporting challenges?
What would be the main challenges for what?
For Brazilian companies, in terms of CSR reporting?
I mean, I think this is perhaps a bit too specific a question. I've not, to be completely honest, I've not thought specifically about I mean, I could see how in Brazil there, especially with the rainforest, that there's sort of major, that there's potentially major issues around CSR reporting, but I've not thought about them sort of specifically that I could sort of answer this specifically for Brazil. But at the same time, I think the way we, for instance, in chapter 3, when we talk about the determinants, I think a lot of the forces that are upon companies in terms of thinking about what the costs and benefits are, I think they apply pretty broadly to the Brazilian companies and companies in other countries. But if you sort of have a very, we want to talk very specifically of Brazil, maybe we should do that offline.
Thank you.
Thank you. Daniele, you're next.
Christian, no, my question is sort of coming from the Andrea Pratt paper on ER or to make it a little bit more accounted to the Giggler et al. 2014 paper. And I was thinking about in the real effect setting, we know that more frequent disclosure usually affects the project selection strategy and may make manager more short-term oriented in the selection of their projects, selection of the firm investments. And so I was wondering if you see that happening here with mandating CSR disclosure. And there's always this negative connotation to short-termism or myopia, but do you think that that would be necessarily bad in a situation like this, where companies and societies are sort of has to face some climate change challenges in the short term?
So it's a good question, and I think let me first say that the reason I highlighted in the talk the short-termism is just early on to sort of highlight how reporting has actually been a catalyst, or criticism of financial reporting and the guidance practices has been a catalyst for sort of this broader shift towards a stakeholder approach that we saw with the Business Roundtable. Whether or not CSR reporting leads to more or less short-termism, I think on one hand, you could argue that one reason why we're contemplating CSR reporting is precisely because companies are not thinking sufficiently long run about sort of some of the climate consequences or some of the long run environmental consequences of their actions. And by reporting on them, we're bringing them forward. We're making the companies respond to them now. So in that sense, it's a form of making them respond to something in the short term. But in this case, it's presumably something that we want, that's desired. And so that bringing forward, in a way, I wouldn't call short-termism. I think that is in essence, making the companies realize that there are these long-term trade-offs that maybe a manager with horizon effects would otherwise not take into account. Now, I will also say that, once share-based compensation gets often criticized, right? But the fact that we're giving managers compensation that's tied to the firm value, and because firm values impound long-run consequences, I think in a way, companies often do have some fairly long-term incentives. And the short-termism debate, sometimes when it focuses just on the guidance, I think is maybe a little bit too extreme, because again, if companies make very stupid short-term decisions that hurt their share price because of the share compensation managers get, they do feel those consequences. But I don't think it's easy to say, if that's sort of was the bottom line of your question, whether or not we'll get less short-termism. But I do think that the whole idea is that we're bringing these long-run consequences to the forefront of the managers by making these consequences more transparent. But as I said, that is not easy, because a lot of these issues are, because they're so far out in the future, are very difficult for companies to report on. And then they can get into trouble if they're sort of reporting on some of these issues that are way out in the future. They're giving their best guesses, and then things play out quite differently.
Thanks.
Thank you. So the next question is from Bona.
Hello, Valbona Sulcai from University of Kentucky here. So my question, I think, touches upon something that you mentioned later on. When it comes to disclosure, once the standard setters jump in and start to mandate what to disclose from companies, there is always that kind of risk where they become boilerplate and less informative to investors when it comes to making decisions. So it looks until now, investors are really driven by these disclosures. And I was kind of wondering to what extent would they be still interested if the standard setters start to, I know in Europe they are mandated. I don't know what is the situation there. how informative or how much are companies disclosing, like what's really what is really pertaining to them, and not just fulfilling that requirement from the standards.
Let me see whether I understood the question right. I think one, you were starting out with the risk of boilerplate disclosures, and to what extent investors then would still be interested in it. Let me first point out that this issue with boilerplate disclosures is not something that just arises in the CSR context, right? We've seen this with financial risk disclosures, where people have also said, the risk factor disclosures are very boilerplate. They serve some kind of insurance or legal hedging strategy, and they're not often all that informative. Although we do have work that suggests that investors still process this information, and they draw some information from it. The same tendency is likely to, and we see this with CSR, that companies could make blanket statements and provide boilerplate disclosures. This is something that the standard setters are very well aware. And to take SASB as an example, but the other standard setters have also thought about this, is that they often say, this is precisely why they, for instance, have issued standards that are by industry. So that they have thought about what are material issues in a certain industry, so that at least companies, there's an expectation there that if you're in the oil and gas industry, here's some things that you would normally provide. If you're in packaging, this is something that you would, could potentially be material. Precisely by giving guidance on what material issues are, with the input often from the industry, from the people that understand the business processes, I think is an attempt to reduce this tendency to see boilerplate disclosures. But again, this is why we were saying in the end, reporting incentives matter so much. And this is why it reminds me so much of the IFRS literature and the insights we generated there, is when, when we implemented IFRS around the world, a lot of the companies were using the discretion. They still had their incentives that came from their local environments, and they were responding to these incentives and using the discretion. The same is going to be happening here. Firms that really want to communicate will provide much more specific disclosures, and companies that are maybe more reluctant, for better or worse, to respond will use the discretion and provide more boilerplate information. But note, again, investors will also judge the specificity of the disclosure, and to the extent that there are benefits to being more specific on certain issues, because investors, as Jeff was saying, want to know certain information, that can then also sort of lead to some kind of unraveling of sorts, where companies then feel like if they're not providing this information, that's going to be viewed negatively.
Thank you.
All right, so several people ask questions about measurement. So let us jump to that questions first, and then we'll go back to the chronological order. Paolo, can you please ask your question?
Yeah, sure. Thank you, Chris, for your excellent presentation. My question is fundamentally related to things that accounting scholars are very familiar with, so measurement and definition. So when we talk about ESG-related real effects, I think we should all realize that those imply a wide range of, dimensions, both related to output, but also to possible impacts that exceed the traditional capital market consequences. Think about climate change effects, or very systemic issues that have to do with global effects. So the issue is, what is your take on the scope of measurement? I think the paramount issue here is, where do we stop in terms of fundamentally generate and communicate and disclose information? And on the second issue is, don't you think that perhaps we should better team up with people, colleagues that are knowledgeable on measuring real effects? And I'm thinking more about natural scientists, those that have spent decades on thinking, for instance, track CO2, climate change effects, or biodiversity, etc. Otherwise, I think as an accounting member of an accounting scholar community, I think we do our work in a way which is always almost imperfect / irrelevant. Thank you.
Can you just, the last point, why do you think it's irrelevant?
Not irrelevant, but it's like we are measuring under the lighting post. So we are measuring in a way that it's going to be, I wouldn't say fully effective or impactful, because particularly there are boundaries across disciplines that could be, say, more powerfully aiming at, gathering forces, particularly in unprecedented times like this one, where we have huge complex issues that from different perspective, policy or corporate environment must face. Thank you.
Right. So let me first agree with the starting point where you were saying the measurement issues here are complex, and because they don't just pertain to financial measurement, that accountants, that's sort of our core expertise, we may sometimes be out of our depth or not necessarily have this kind of expertise. And if you look at the standards that have been put out by the various standard setters on this, you see exactly what you're saying. A lot of the measurement pertains to physical activities, non-monetary measurement, and that is a challenge. And when we were pointing out that we need to think about auditing and enforcement, that also means that the auditors are not necessarily experts in that space and in verifying some of the measurements and disclosures. But it's not something that we haven't seen before. I mean, auditors often do rely on experts in coming to their audit opinions, and they bring in these experts on specific challenges. Here, we probably have to bring in more technical expertise. Now, so I think companies and auditors can do this, but it will require bringing in perhaps outside expertise in certain circumstances. The same is going to be true for us, right? But it is true that maybe sometimes we are not naturally equipped to do this because this is not our forte or where we have expertise. But let me give you two examples, and I think it will boil down to this, what you mentioned, that you could have like partnerships. So for instance, again, Saurabh Tawar has this really interesting paper on CO2 disclosures, where he exploits that carbon monoxide disclosures in the pre-period are observed and have been disclosed. And then he basically estimates at the process level what the relationship is between CO and CO2 to kind of get a sense for what companies' emissions were in the pre-period. Clearly, this is something where you need to develop some technical expertise. And he reached out to people that are in the sciences that do this, both on the estimation part, but also understanding sort of what these relationships are, at the process level. Can you estimate this? I'm doing some work with Joanna Michelon and Pietro Bonetti, where we're basically studying fracking and water quality. And there we've reached out extensively to people in the water space to understand better what water quality measurements are. Sometimes it means you do this together, and sometimes you just have to spend a lot more time understanding these measurements. But I think accountants are good at measurement. And so I wouldn't say that we can't get more into this space and broaden our field. And that's why I think I'm excited about seeing people working in that space, rather than telling them we should stick to the financial reporting side of things.
Thank you.
Thank you very much. So we still have a number of questions, probably in time just for one question. I'll ask Maria to ask a question, and then we'll end it here.
Hi, Christian. So my question is related to the one you were just answering a second ago, and it is related to measurement, but a little bit different facet of it. So one of the studies that you have gone over in your survey actually mentioned that many companies, and majority of them actually, I think, had no idea where even their raw materials came from and what impact they may have had on the environment or sustainability issues. And then
Maria, sorry to interrupt you, but I didn't hear, what did companies have no idea?
Where the raw materials were coming from.
Yeah.
So that was one part of it. And the other part of it is when you talk about the measurement issues, you seem to be concentrating on accounting side of it, or measuring them in the same way that we do measure things nowadays for anything else. But what I wonder is, could we measure them somehow differently? Could we perhaps come up with some units that we would assign to environmental or societal impact that would be in parallel to accounting measurement, but wouldn't necessarily require quantification in the sense that we do it in accounting? What would your thoughts be on those two aspects? So one, the lack of information at the company level, and two, coming up perhaps with a different measurement system.
Yeah, so I have a little bit of a family background in the in the jewelry business, and so I know about conflict minerals and how difficult it is to trace the origins of, for instance, diamonds. And so it is a real issue for companies to kind of trace the supply lines. But again, if we see, I think for me, a lot of it starts with the starting point. If we're saying we want reporting on that, or we want maybe even a mandate on it, then I think those measurement issues need to be addressed, and they are non-trivial, and they're potentially quite costly to the companies. But this is why I think the standards, just like with financial reporting standards, need to be developed with industry input, that we get a sense for what is feasible. I think there's also a lot of scope for NGOs or third parties helping with the measurement. That might often, for instance, when it comes to measurement of carbon impacts, it doesn't always mean that the company itself has to do that measurement. It could be that we standardize certain measurements, or we develop basically measurements for certain products that we then can report. So the company knows the quantities, they know what they're producing, they know what their inputs are, but they might not know what goes into these inputs. And so if we had sort of an NGO, or we had information from a third party that would say, well, that's how much carbon goes into these inputs, then the company can do the aggregation. So I think this is where we need creative solutions, many of which are underway. And then the second part, remind me, what was the second?
Sorry. In the second part, I was wondering if we need to force the measurement in the same sense as we force it on financial items and financial statements, or if we could perhaps consider designing a different measurement system, some type of a system where we would have these societal environmental units that we would account for in parallel to our regular accounting system.
I mean, I think, so let me give you an example of something that I think came up at the, in Davos. Somebody proposed and said, couldn't we just do sort of, a bottom line in the income statement where you take, a company measures its carbon, and then we have a price for carbon, and then we'll just measure the societal impact by, subtracting that at the bottom from the income statement. And there was some back of the envelope, how that would wipe out a lot of the profits of the oil companies. And so I think there are sort of creative ways in which you could bring it into even the measurements that we are familiar with. But a lot of times I think what we're talking about is actually not forcing it into a financial reporting system. I mean, we're not talking income statements, balance sheets. We're actually most of the time talking about disclosures, and the free form of the disclosures is often what then leads to this call for harmonization, where people said, well, wouldn't it be nice if we, for companies within an industry, had a table that everybody reported so that we could read it in, we could sort of use it in a more standardized way. And it also goes back to the earlier debate about boilerplate, right? So if we say we're going to make it entirely free form and we're not going to push measurement, we're not going to push metrics, then there's always this concern that people will just provide qualitative responses. And then the question is, how useful are those are going to be? So in my mind, I think this idea of saying we're going for tabular disclosures, we're going for metrics, is taking it seriously, right? But at the same time, it will create these challenges that I said in my first response to your question.
Thank you, Christian.
All right.
Okay.
Thank you, Christian, for your talk. Thank you, everybody, for asking questions. Thank you, everyone, for joining. We hope to see you next week. Please have a nice weekend and stay safe.
Thank you, guys, for organizing. This was fantastic. I enjoyed it.
Thank you. Take care, everybody.
Bye.